Here, big banks we have been monitoring all week, taking center stage this week as they wrap up earnings, but several top CEOs warned of possible economic headwinds still to come.
We don't see the activity on the consumer side slowing at a pace that would indicate that, but we see commercial customers are being more careful and things like that. But everything points to a relatively mild recession.
People need to be prepared for the potential of higher rates for longer. If and when that happens, it will undress problems in the economy.
While the forward trajectory is still unclear, we continue to be cautious about the economic outlook, and we are operating the firm such that we are well prepared in the event that the environment weakens further.
All right, fun stuff there. For more on how all of this plays into the Fed's next move, we're joined by Eugenio Aleman, who is the Raymond James chief economist. All right, so we've gotten more flashing warning signals from all of the heads of the big banks right now. How are you reading into this? What does the timeline look like? It sounds like Q3 2023 is when they're expecting for a recession to hit.
Yes, we have a recession hitting the economy during the third quarter of the year and lasting just 2 quarters. But it will be a very, very mild recession according to our estimates. And the reason for this is because we still have plenty of cash available, and the consumer is doing relatively well, and employment continues to be very strong, and the labor market remains very tight. So for now, as long as employment continues to grow, we see the economy slowing down, but not collapsing.
And what you have heard so far, Eugenio, from some of the bank CEOs and other companies that have reported, has that, I mean, I know that you, as an economist, you typically look at economic data, right, and sort of look at the macro picture and top down. But I'm sure you also pay some attention to sort of that more, the color, if you will, that you hear from CEOs and whatnot. Is there anything in particular that stood out to you, and does that support the view that you're talking about?
Yes, I think that everybody has been moving away from a deep recession into a more milder recession. I mean, large banks have come out with earnings, and earnings have been better than what markets were expecting. So, I think that this time is different, I would say, but I know that is a cliche. But the biggest issue is that this cycle hasn't been a monetary cycle, it has been a fiscal cycle. And that fiscal cycle has been flushing out of the system. All these monies that were transferring to consumers and businesses are continuing to flush out. And this wasn't a typical monetary cycle in which banks gave lots of loans, and now they are in trouble because they cannot collect. That is not the case. So we expect banks to continue to do relatively well.
What would define then a recession if entered into in Q3 2023? Because last year we heard everyone from economists, even up to the White House, try to really determine this broader kind of thinking around 2 negative quarters of GDP equaling a recession, or at least that had been the common thinking going into it. So what would be the characteristics that would define a recession, of course, even as we would still wait for the NBER to really determine that one had been entered into?
Yes, that's very interesting. Very good question. The biggest issue today is the consumer, because we have seen that residential investment has been down for the last 6 quarters, consecutive 6 quarters. So that has not been able to bring down the economy because consumption has been relatively strong. Last year, exports were very, very strong because of exports of natural gas to Europe. So today, what we are waiting for is for employment to weaken and then consumer demand weaken. Not by a very large amount, but slow down in consumer expenditures. The Fed is doing the correct thing. Interest rates on savings are going up. So that will put pressure on consumers between consuming and saving. which is something that we haven't had for the last 20 years or so, right? I mean, interest rates on savings accounts have been so low that consumers, will decide to consume rather than save. Today, they have these alternatives. If you slow down saving, if you slow down consuming, you can get a reasonably high interest rates on savings. So I think that is what the Fed is playing with interest rates today. The second portion is credit card lending. Credit card lending is the only component of lending that has been growing too fast for the Fed's pace. And I think that is one of the targets that the Fed is looking for today. Slowing down credit card borrowing because it is the most expensive part of borrowing.
And of course, overall, they want to target inflation. You wrote in a recent note, it sounds like you're not too terribly optimistic about some of the stubborn portions of inflation coming down. Can you elaborate for us?
Yes, the Fed is basically looking to two sectors. One is housing or shelter costs. And we believe that component is going to start coming down in the second half of this year. So that portion of inflation is going to help slowing down or disinflate the U.S. economy. But the Fed is also looking at core services excluding shelter. And those prices are still going up. And the reason why is because the service sector is very strong. So they want to convince the service side, because they have no other way of doing it, that they should slow down employment. But again, if you're a restaurant owner, why would any restaurant would say, okay, we are going to slow down employment if we have our business full? So that is what the Fed is trying to do, just trying to convince businesses that they have to slow down, and hopefully that will be enough to slow down the economy so as to bring down that service excluding shelter component of inflation that is still growing.
Yeah, fingers crossed for the Fed and for us, for that matter. Eugenio, thank you so much. Eugenio Aleman, Raymond James, Chief Economist. Thank you.